Last time, we read Redline's income statement down to the bottom line, about $9 million of profit, a record year. So here's the next question a lender, CFO, or operator would ask. How much of that $9 million actually showed up as cash in the bank? The statement that answers that is this one, the cash flow statement. Profit and cash are not the same thing. By the end, you'll be able to read this statement from top to bottom. The cash flow statement starts where the income statement ended, net income. That's on purpose. Its job is to take the profit number and translate it into cash. Some items affected profit but did not move cash. Other items moved cash but never touched the income statement directly. The statement sorts those differences into three sections: operating, investing, and financing. So we begin with net income. Redline reported about $9.1 million of profit. Now the adjustments begin. First, the add-backs. Depreciation lowered profit by about $4.2 million, but no cash left the building this year to pay for it. That cash left earlier when Redline bought the equipment. Depreciation spreads that cost over time. So to get back to cash, we add depreciation back. Same idea with deferred taxes and stock-based compensation. They are real charges against profit, but they did not send cash out the door this year. Together, those add-backs give Redline about $5.4 million back. So far, the cash story looks better than the profit story. $9.1 million of profit becomes roughly $14.5 million before working capital. Hold that thought, because now comes the part that catches people. To ship a record year, Redline had to extend credit to customers and build inventory. Both use cash. Accounts receivable grew by about $8.5 million. That means Redline booked sales as revenue but had not collected the cash yet. The income statement counted the sale. The bank account did not. Inventory grew by about $6 million. That is cash sitting in parts, work in process, and finished product that has not turned back into customer cash yet. Receivables and inventory together tied up more than $14 million. That is the trap. A company can be profitable, the factory can be busy, sales can be up, and cash can still get swallowed by working capital. Payables and accrued expenses gave some cash back. Redline held its own bills a little longer, and some expenses were accrued but not yet paid. That helped, but not enough. Net, working capital drained about $12.2 million this year. So total it up. Start with $9.1 million of profit. Add back about $5.4 million of non-cash charges. Subtract about $12.2 million of working capital. And you land here. Operating cash flow of about $2.3 million. Read that again. The income statement said the business earned $9 million. The cash flow statement says it actually produced $2 million. That gap, about $6.8 million, is the key lesson. The profit was real. The cash just had not arrived yet. That is not fraud. That is timing. And timing can still become a problem. 2 sections left, and they are quicker. Investing shows what Redline spent on long-term assets. Capital expenditures were about $5.2 million. For a factory, that means equipment, tooling, facility improvements, and other productive assets. So Redline generated about $2.3 million from operations, then spent about $5.2 million on capital expenditures. That cash had to come from somewhere. That takes us to financing. Financing shows how the company raised or returned capital. Redline drew about $4.8 million on its revolving credit line. It also paid down about $4.5 million of term loan principal. Net, financing was close to break even. But look at why the revolver was drawn. The company borrowed to cover the cash that working capital swallowed. That is a signal an operator never ignores. When the credit line starts funding the day-to-day, the business may still be fine, but the clock is now part of the conversation. Now add the three sections together. Operating cash flow was positive $2.3 million. Investing cash flow was negative $5.2 million. Financing cash flow was positive $0.3 million. Together, Redline's cash went down about $2.6 million. That is the bottom line of the cash flow statement. Redline started the year with about $6.8 million in cash. It ended with about $4.2 million. Say that out loud. A record revenue, record profit year, and the bank balance shrank. That is why this statement exists. Profit can climb while cash falls.